Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app.
All right, welcome to Market Call. It is Thursday, May 8th, 11 a.m. on the East Coast. I know I sound like Guy Adami. That's how he usually brings us in. But we have a very special edition of the Market Call. You don't see Guy Adami here. You see CC Lagator. CC Lagator is one of the founders of Options AI. He's one of my oldest friends. CC and I went to college together. We graduated 30 years ago. Right after college, CC went into options trading and did that for a couple decades. And he started this fintech company, but he also started the Risk Reversal brand with me going back to 2011 when it was a blog about markets and trading and options and all that sort of stuff. CC, welcome to the Market Call.
Look at us now. We're doing it.
We're all grown up. You guys might recognize CC's name. He's been writing our newsletter starting Jan 1 this year. It's really great. We're loving the commentary. We're loving basically a recap of a lot of the content that we're doing throughout the day. It's a look ahead. It's a bunch of option stuff. There's some trade ideas in there. So if you're not already following the Risk Reversal newsletter, please go to riskreversal.com and do that. You'll get to hear from CC every day after the close. Obviously, Guy and I and the rest of our team are participating in that. So, but it's really great, and we're really happy to have CC part of the team. We got a lot of stuff to go through here today. We have John Butters in the weekly earnings insight. That is the blog that he puts out every Friday. We get a preview of that, so we're going to hit that. We also have our friends from SoFi. We're going to try to get all the market stuff right in this one show. So Liz Young-Thomas, we miss her. She's on maternity leave. We're very happy for her about that. But Mario has sending us a lot of data in the note that they put out on a weekly basis. So we're going to hit some of that. Obviously, top of mind right here is what's going on with the trade war. And, President Trump had kind of teased a big deal. So it was going to be a very big deal, something like we've never seen before with the UK. UK is our 9th largest trading partner. And interestingly enough, it's the only one of those top 10 that we have a trade surplus with. So if there was ever a deal to be done and get it out of the way, it was this one. CC, when we think about the markets and we think about what's being priced into, just from a volatility standpoint on a day like today, where you get the announcement teased and then the deal comes out, and it's not out just yet, but I think anybody can kind of guess it's not going to be like this toothy sort of thing. It might be a framework for other deals. Does the option market start to price this in on a day-to-day basis, or have we just kind of gone to levels over the last month or so where it's going to take a really big announcement, probably something on China, to cause volatility, or at least, the expectations of volatility to come down a lot?
Yeah, and the options market, at some point, it also becomes self-fulfilling. And I've been writing about this a little bit in the newsletter that, when you see that VIX come back to the low 20s, what we are right now, not only is it trader expectations of big, like a face ripping rally from here, or a huge, you wake up in the morning and there's a big puke in the futures. Not only is it doing, saying that those things are less possible or less likely, but it's also behind the scenes, it's doing that as well. And so that's what I've been writing about a little bit this last week, is the expectations. You come in the morning and there's a trade deal. We aren't going to be up 3-4%. I mean, maybe China, but that's not in the cards right now. And the same thing, you're going to find buyers below here when you come in the morning and the futures are lower. We're not going to just turn around and suddenly go back to a VIX 40 overnight.
Yeah. And again, that would take like a real meltdown, I think. Like, so for instance, Treasury Secretary Besson, he's going to Switzerland. He's supposed to meet with some very, very senior Chinese official. Hopefully they'll probably both have an interest in de-escalating the rhetoric, right? One way or another. I'm not sure the Treasury Secretary going over there can do that, because the next thing that can happen is Trump just kind of hears something that is not public about the negotiations, right? And then he sounds off on it. So I don't expect a whole heck of a lot of clarity. I keep going back to the fact that in the first Trump administration, they first slapped tariffs on China in 2018. It was March. They did not have the framework for a deal. They were calling a phase one deal until January of 2020. So almost 2 years after the fact. So could things move differently this time around? Sure. I think we heard Paul Tudor Jones on CNBC the other morning say that even if you were going to kind of take back this 145% tariff and it kind of finds itself at 50, massive disruption to the global economy there. So again, I think you can keep an eye on the options market. I'm not sure the VIX is telling you a whole heck of a lot here, but the other headline that we should just follow is on China. So the Chinese are going to take a really hard stance as it relates to these negotiations. They are a culture where the whole idea of saving face is really important. President Xi is a guy who doesn't have to worry about midterms. He doesn't have to worry about being reelected himself. They can play the long game. They're already starting to stimulate their economy. Let's be clear. They've been doing that for a long time. Their economy is really weak. No one thinks for any reason that they can hold out, another 2 years with this sort of pressure on them, but ultimately it's going to take a little bit to get that. So CC, in your mind, at least as through the lens of the options market, the only thing that would really cause a big move one way or another would be some sort of movement in China. It could go back, it could go forward, who knows?
Well, I guess the question is, we think about the two biggest, most volatile days we've seen over the last month and a half. They were the Rose Garden appearance with the tariff announcement, and then that was the 90-day reprieve. And in both cases, it was sweeping. It was everyone. It was it was picking a fight with the entire planet and then letting them off the hook, the entire planet. So the question would be with China, is the China story really the story here with the tariffs, right? And so is a China headline big enough? But to your point, like even this UK deal, it sounds like it's not actually a deal. It's not written. These things take months, right?
Yeah, except for the fact that they were just imposed out of nowhere on shaky math. And so the idea of kind of taking a lot of that back. I mean, listen, I don't think Trump loses a whole heck of a lot of face to come out and say, we got to deal with UK, we got to deal with the EU, we got to deal with Canada, we got to deal with Mexico. And I think it's one of those situations where maybe it was so extreme that the ability to kind of pull back most of it, but still leave some in place, and then rally all of those allies behind you to then deal with China. Because make no mistake about it, this is a new Cold War. It's a Cold War from an economic standpoint, but there's lots of repercussions as it relates to the global economy, but also the defense of our allies, the defense of our own industry, the defense of our country, all that sort of stuff. So we'll hit a little bit more of that as it relates to technology. But I want to go to the S&P 500 for a second, because Guy and I have been talking about this, over the last week. You got this V reversal, right, from the first half of the month in April. We came basically all the way back to where we were on April 2nd, April 3rd. And here we are. We have a flattening 200-day moving average. In my mind, I still can't conceive of too many headlines in the near term that get us meaningfully above that 200-day moving average, back on the way towards 6,000. But who knows? You know what I mean? Some, may say that it wouldn't take a whole heck of a lot, at least a couple just headlines as it relates to China, at least things cooling out. Maybe I think then you got to focus again on earnings growth, the multiple of the market, that sort of thing. See, when you see a flattening 200-day moving average, you see a market that was extremely volatile come back to a prior level. At what point do you think, okay, options might be cheap enough to basically, get long exposure that would take you back towards the prior highs, or just say, listen, I want to hedge a portfolio again, or I want to make an outright bearish bet. With a VIX at 24 or on its way down, let's say to 20, if that were the case, if things were to settle down, is that enough to basically say, you know what, I can start making directional sort of views in the options market, and you're not going to get too apart as far as volatility decay?
Yeah, and also just the sort of runs that the SPX is going to make to the upside. While you were saying that, I was just looking at the expected move out into May expiration, and it's about, it's just above that 200-day. It's closer to 5,800. And so basically what the options market is saying is the chances of a face-ripping rally, people aren't, they're not pricing it in right now. So that includes the potential for a big, China deal or anything like that. Now, on the flip side to your specific question, I've been writing about this in the newsletter the last week or so. It is a point when you see the VIX, if you're in this volatile of a market, right? So sometimes this is a V reversal and that was everything, it's over. It tends not to be that, right? You at least see another bout of volatility. If not, it becomes a bear market, right? So in this case, you've got, when you see the VIX go to 60 and then you see it come back to the low 20s, it is time to start looking lower, right? So the options market, the market has given you a second chance to reassess your positioning. And that doesn't need to be through options, right? But it should be, you know, as Danny Moses says when he's on the show, it's like, you know, get rid of your crap and, you know, it's like reassess what your positioning is at this moment. And when you see a VIX that's 22 or 21 right after it was 60, this is the moment. And especially when you're seeing that technical level as well.
Yeah. So if we go back to last July, maybe Amanda can zoom in a little bit on that sell-off, which I think was about 10% from the highs in late July into August 5th, where we really did crescendo. And you see, we got back to that prior level. We didn't actually make a new high. You know, that July level was all-time highs, right? And so, Amanda, maybe you can kind of tell us what on that second sell-off that we saw into early September from a percentage basis, what was that? Because that's CC's point in a way. You know, that's only useful if you're trading. You know what I'm saying? Like, right? And so, like, a lot of the stuff that we talk about, you know, on a percentage basis, what was that? Probably half of what we were on the way down, maybe 5% or something like that. And then you see a V reversal. You know, one of the things that we've mentioned from a technical perspective frequently is that, you know, that 200-day moving average, that was like, it didn't even sniff. The S&P didn't sniff it, even in that sell-off in August. And it was telling you a little something that there was still a lot of support underneath the market. So again, pretty interesting. I've also been mentioning that, you know, the 10-year US Treasury yield, that's the thing that I'm more focused on rather than the VIX right here. Obviously, the VIX measures the volatility of the S&P 500, but the 10-year yield was the thing that got the administration to blink. Now, why was that? Well, they came into this trade war suggesting that they don't care about the stock market on a near-term basis. What they were targeting was the 10-year yield, and they wanted it lower for a whole host of reasons. They have to roll $9 trillion of our debt. They'd rather see interest rates much lower than higher, right? Because just for debt services purposes. But here you are. You have a 10-year yield that has a flattening 200-day moving average, and it's nearly at the same spot it was a year ago. See, thoughts on that? Because, you know, we can look at the MOVE index, which is actually something that tracks the volatility of the Treasury market, and that's kind of the equivalent of the VIX. It was very volatile. Now it's less volatile. You see the range just over the last month and a half or so. So this thing calming down, I think, is probably good for equity vol too.
It definitely is. And I think you and I have joked about this in the, you know, recently. The 10-year yield is basically that scene in The Simpsons where Mr. Burns goes to the doctor and there's so much wrong with them, but they're all equally balanced.
Yeah.
That kind of feels like the 10-year right now. It's like, is it pricing inflation one day? Is it, you know, pricing the slowing growth the next day? And it's just kind of all settling in. And obviously we had that moment last month that spooked the markets and, you know, got the administration to back off on the tariffs and everything. And we've kind of settled in here. And it's probably, you know, each day when I'm writing that end of the day piece, I'm always looking at like, well, what did gold do today? What did the 10-year do today? What did oil do today? Is this indicating a recession? Is this indicating inflation? And it's sort of all of the above all week. It depends on the day.
Well, that gets you to stagflation. So our good friend Doug Cass of Seabreeze Partners, who writes for the streetpro.com, he sent over a chart, really good one. And I just want to be really clear about Doug. Doug has forgotten more about markets and movement and valuation and sentiment and all the other things than I'll never ever know. Okay. Like, I just want to be really clear about that. Really transparent, writes every day. He's on the Twitter. He's got the newsletter. So when I see a chart like this from him, I think it's really important. So he's saying the best indicator of success of a tariff policy would be a stronger US dollar. The dollar sold off obviously precipitously when the trade, war was kind of launched, and just kind of, again, I think it was the rollout of the trade war, the inconsistency of a lot of the policy caused folks just to sell dollars. I mean, they were just like, losing trust in us as a trading partner and all that sort of stuff. And so if you see the way in which the dollar is sold off, and you also see, let's just pull up the US dollar index here, you just see it kind of stuck in the mud down here, 99, 100 or so. Like, if there's going to be greater confidence that this trade war is going to end soon, that we are going to have some agreements that everybody could feel good about, then you would see a dollar possibly moving higher. You have a downward sloping 200-day moving average that was just flat or so, and you see the way in which it sold off over the last few months. I might think, okay, this thing could be heading back to 103, 104, that sort of thing, but it's not. So it's interesting to me to kind of think about what might be the conditions in which the dollar could start rallying again, CC.
Yeah. And it is, again, these were those, at first it was the 10-year that spooked everybody. And then over those next 2 weeks, it was the dollar. And this is, again, you've got to be keeping an eye on this. And I think we're going to get to gold in a bit. And it's sort of the same thing with Guy. I think he mentioned it the other day. He was like, when you see gold spiking to new highs and going parabolic, it's the same thing with the dollar. When you see that, it's not a good sign for other risk assets.
Yeah, and that's the point. And I've been saying this. So 10 years more interesting to me than the VIX. Gold, and the way in which it's moved on these periods where, there's a lot of unease about us as a trading partner and the length of a projected trade war and all that sort of stuff. So gold yesterday or 2 days ago made actually a new closing high. So if you see that spike from basically a month ago or so, it actually had that huge move higher towards 3,500. It kissed it and then it reversed. And so yesterday or 2 days ago, excuse me, it was a new closing high. So you might have the VIX moderating. You might have the 10-year yield going sideways. You may have the dollar, the US dollar index, trying to make a little bit of a bottom, or at least consolidating at lows that we have not seen in 3 years or so. But the gold movement is something that I think is almost more important to keep an eye on as it relates to sentiment, which brings us to nerd gold, CC. This is one that, I think a lot of folks were fairly disappointed in the way in which it acted, in February into April or so. It retraced that entire move from the breakout from the election. And here it is. It's back on its horse. Now, okay, weak dollar. That's the reason why this thing exists, right? So the debasement of fiat currency, specifically the dollar. So this is now acting the way you would have expected it to. It hasn't kept pace with gold, the shiny metal gold, but it's starting to kind of move back in a direction that you might have expected with a weak dollar and strong gold.
Yeah, and this one's kind of fascinating to me. I mean, I am not a gold bug and I'm not a Bitcoin bro in any way, but it started acting differently even when we were close to the lows in the market. It had like this odd bid under it, right? And I think if you went back and you compared it to, say, the Qs before we had this V reversal, it was holding up pretty well. Like, I think I texted you guys at some point. I was like, I'm shocked it's not trading 60,000. Like, what's going on? And because I used to always look at it as the ultimate sentiment indicator. And a lot of times that was the froth in the market sentiment indicator, right? I even use it on weekends, like before the futures open. I'm like, oh, I can kind of guess how the futures are going to open based upon how Bitcoin traded over the weekend.
Yeah, so, very correlated to the NASDAQ, right? And that's yeah. But one thing that's interesting, and I just want to kind of double click on that rising 200-day moving average. There's very few risk assets that I see that have a rising 200-day moving average. And Amanda, if you could just pull up, let's say, the QQQ, the NASDAQ 100, or the ETF that tracks it with a 200-day moving average there, to me, what I find interesting is that, it has not been able to break through that yet. And that moving average is sideways to sloping lower. And if you see how far away it is from those all-time highs. So again, it's not like the best correlation, but it's interesting enough. And this one on a relative basis is acting worse.
And I have a slight hot take on both the gold and Bitcoin versus the Qs thing. So basically, I think we're in this in-between period, right? Where you had this 90-day reprieve of tariffs. You have a pull forward that's very confusing in the economic data right now. You have, we don't, like the economic numbers themselves aren't coming in yet with much clarity. So we're in this weird holding pattern, and equities tend to rally in moments like that, right? You're not waking up to like some really bearish headline or anything like that. Those are the times when you kind of start to pay attention to what's going on under the surface, right? And so gold continuing to rally, Bitcoin kind of starting to act like gold now. The dollar is one to keep an eye on. Oil getting crushed last week. Like what, and all of those things you sort of say, all right, is this building up? Is this like a rubber band building up and about to kind of hit equities? We'll see. Now, the bullish argument of that is if we get some tariff deals and everything like that, then you have this pull forward and then you don't have the negative thing after. But I just saw somebody mention in chat, like there's one container ship in Seattle or whatever, those kinds of things. It's like, it's starting to be real.
All right. So on that front, and I'm not going to belabor this too much, but maybe Amanda and Jacob could put this in the show notes. Steve Eisman, who's been on the pod, he comes on Fast Money with us. He was a Big Short fame. Danny, Moses, Vinny, and Porter all worked for Steve back at Front Point. They were obviously depicted in The Big Short, the movie and the book. Steve had a guy, I think his name is Craig Fuller, who runs a company that does analysis on logistics. Okay. So from shipping to multimodal to, so that's trucking and rails, last mile stuff, and everything in and around it. It was a great conversation. It was talking about just what's going on in the West Coast. There are 500,000 workers in the logistics business in Southern California alone. There are 9 million in the country. And some of the data that they're seeing like dramatic slowdowns right now. Go listen to this podcast. Is the Steve Eisman pod or show or something like that. We'll put it in the show notes. Really interesting conversation on that front. Like let's before we get to stocks, and I promise you, we're going to do a bunch of single stock stuff. And that kind of speaks to what CC was just saying, looking under the hood, because earnings season is nearly over. And we did glean a lot of stuff from that. And I think that, top down is what we just spent a lot of time doing. We're going to do the bottoms up. But I want to go right now to Mario's blog from SoFi. You guys know where to find it. They're going to put it up right now, and we're going to give you a bit of a reminder. But this is some interesting data that they have right here on inflation expectations. You can get this blog, SoFi.com/on-the-money. It's there right now. Take a look at it. All right, let's do this really quickly here. Investors expect inflation to average 2.8% over the next 2 years, and the Fed to lower interest rates by 1.1 percentage points. At the start of the year, those figures were 2.53% and 0.62 percentage points, respectively. More rate cuts alongside higher inflation suggests investors think labor market and growth concerns will take precedence over inflation. Okay, so the concern there, if you're worried about labor market and growth, that speaks obviously to a slowing economy, and inflation right now, despite expectations still very high relative to where it has been in the past. If you think about what the Fed's dual mandate, and obviously the Fed met yesterday, a lot of the press conference was focused on that dual mandate growth in the jobs market relative to prices, right? And they just said that they still have too much uncertainty to kind of weigh in too hard on that. So when you think about that right now, over the next 2 years, you still have expectations for inflation well above the Fed's 2.8 or 2% target, right? And then if you think about what you're expecting for interest rate cuts right now, I think this data is suggesting that the Fed funds rate, which is now at 4.5% at the higher band, will be 3.4%. Right. So the ability for the Fed to cut interest rates, which should be stimulative for the economy. Thoughts there, CC, because this is, I think, really important data. Inflation expectations are going to dominate the Fed's ability to cut interest rates. But like they did last fall, they cut interest rates because they were worried about the jobs market and they were worried about global growth or growth here in the U.S.
Yeah, and the initial reaction to, and it wasn't that strong of a reaction by the market, like yields didn't move that much. The market, equities didn't move that much, but it was basically saying, it was investors saying when push comes to shove, the Fed is going to slightly ignore inflation and focus on jobs and growth, right? And it was, I put that, Peter Bookvar had hit that yesterday right after the meeting, and that was clearly the reaction. Now, this is kind of interesting because we're looking at investor inflation numbers, but then you have the consumer inflation numbers too, which are double that, right? Like, I don't know where they're getting that information from, but they have massive inflationary expectations. They are pulling forward on their spending. We're seeing odd stuff with, like the restaurants, McDonald's and Wendy's and everything reporting, Popeyes, all that kind of stuff. So it's very odd behavior right now. And we're kind of in this really weird period where the expectations at some point become reality, right? I mean, it's a animal spirits type thing.
Well, you're seeing that pull forward, like you said, from consumers if they're worried about iPhones costing $2,000 relative to $1,000, that sort of thing. And on the flip side of that, you're seeing a trade down from McDonald's. And I think those are really important things to kind of keep an eye on. And, Guy has used this expression all the time that a lot of U.S. consumers, as confidence wanes, as inflation expectations rise, they're fighting inflation with credit and delinquencies are starting to rise. So those are the things that, I think for a lot of us who comment on this stuff, it's really hard to see. We don't like to see our fellow Americans having this sort of uncertainty and trepidation about spending money, because now they're going to start having a little worry about their job, that sort of thing. So these are all things that I think are really important to keep track of, and they obviously signal to a potential weakening economy. Last point on this chart here, the Fed's wait and see approach signals a higher bar for policy easing, despite what some investors might be hoping for, until the Fed gets the greater clarity it's seeking. It seems the likely is future moves. It will mean no moves at all for the Fed. So it'll be interesting to see the Fed funds futures. And we track the CME Fed funds tracker pretty closely here. And again, there's not a great likelihood of a June cut, but that's increasing in July. Let's go to the next piece of data that they have, multi-asset volatility. While volatility has declined meaningfully from its recent highs, it remains above its typical historical levels. Investor sentiment will probably be reactive to news flow on trade, which suggests that the relatively recent calm might be more fragile than it appears. This is all stuff we don't have to comment too much more of that. We covered this. It's great that they are tracking this multi-asset volatility, but this is kind of what we were in agreement for, CC, as we talked about the potential for using volatility as it comes in as ways to express views one way or another.
And just real quick on this, if you remember, the last two bouts of volatility started about a week before a tariff deadline, a week and a half, right? We had it going into the March deadline, and then we had it going into the April deadline. So if you just go out a little bit and you go to the 90-day deadline, I think is the first week of July when it expires. So you can almost sort of think of it that way. If progress has not been made by then, we're in for it again.
Yeah, no doubt. All right. Well, thanks to Mario for all that data. You know where to find that on the SoFi blog there. We appreciate that contribution. All right, let's go to under the hood stuff. Okay. It's a bit macro before we get granular, but this is about earnings. And so every Wednesday or Thursday, today's Thursday, we get a look at the Earnings Insight blog that is written by our main man, John Butters, who is the senior earnings analyst over there at FactSet. You can find his blog in your email box every Friday morning, factset.com/subscribe. Also, Guy and I did a podcast with our friend John Butters on the FactSet on their Insight let me just do this again, because we like to clip this for our main friends or our fine sponsors.
Use your words, Dan.
All right, you know what, CC, I've been talking a lot, man, and I'm just ready for a little bit of a breather as we get into the
All right, I'll take over.
No, I got it. You just sit there here, okay?
All right.
Every Wednesday or Thursday, we get a preview of the Earnings Insight blog. That is written by our main man, John Butters, who's the senior earnings analyst over there at FactSet. If you want it in your inbox on Friday mornings, go to factset.com/insight/subscribe. All right, this week, really important data to me. We are probably 85% through the S&P 500 earnings here, and John tracks this data on a weekly basis. This really gives us a sense of kind of what the general themes are throughout the earnings period here. I want to hit some of this stuff right now. Okay, so John is looking at the S&P 500 Q1 earnings growth year over year versus the Mag 7 and the other 493. This is something we've spent a lot of time talking about. The market has rewarded, and this is really important because some of the biggest moves we had so far have been in these Mag 7 names. If you remember, Microsoft rallied 9% last week on its earnings. That's a huge move for a stock as large as Microsoft. Last quarter, Microsoft was down 8% on that. All right, so let's look at some of the data here. The market has rewarded positive EPS surprises more than average and punished negative EPS surprises less than average for Q1 to date. Companies reporting positive EPS surprises have seen an average price increase of 1.7%, which is larger than the 5-year average of 1%. Companies reporting negative EPS surprises have seen an average price decrease of 1.7%, which is smaller than the 5-year average of down 2.3%. CC, give us a sense, at least how you think about this through the lens of the options market, because this makes sense to me in a heightened volatility period like we've been in. That wasn't great for setups, I think, for individual names, because we were in a 25 VIX environment, which is not usually the case heading into earnings season.
Yeah. So basically, no matter where the VIX is, on average over time, stocks stay within their expected move about 70% of the time. But obviously, the individual stocks and their options can't avoid the overall market backdrop. So when you have a VIX that's 40, that means everybody's options are super fat. You're getting these really fat expected moves. There were some eye-popping ones I put in the newsletter this Sunday. I was like, these are eye-popping numbers. You're seeing like 20% expected moves in some of these names. That might have been 12% expected moves in normal times, right? So it makes sense. And the fact that the downside has been less, it's a lot of these earnings have happened in this V reversal, on the backside of this V reversal, right?
Yep.
So yeah, I would just say that most people, that like the way they should think about these expected moves, the way that these stocks are moving versus those expected moves, the way that they're, sort of leaning towards one direction. Obviously, they're beats more than misses. But people should think about it as it happens normally about, 2 out of 3 times. It stays within its expected move. When it goes outside of that, that's when things get crazy.
Yeah, no doubt. All right. This is really important to me too. The more positive price reactions to Q1 earnings surprises do not appear to be related to earnings outlooks for Q2. That is really interesting to me, because I would have thought that it was baked in the cake Q1, right? That the stocks wouldn't be reacting to that. They'd be more focused on Q2 earnings when you consider, or Q2 guidance, when you consider just the uncertainty that we have as far as the path forward with the trade war. Analysts have made larger cuts to EPS estimates than average for Q2 to date. The percentage of companies issuing negative EPS guidance for Q2 is equal to the 5-year average. Also fascinating. I thought that would have been much, much higher. So this is all speaking to me, CC, about some complacency as it relates to individual names.
I remember Google's report where it snapped higher and then it spent the next 2 days going lower, and now it's even lower with the recent news. I thought that was going to be a trend.
Yeah.
And then we got sort of Microsoft and Meta, and they held those gains, and then they extended on those gains. I thought people were going to look at the past quarter and be like, what difference does that make? Right? That's all in the past. We've got to live in the future in the next couple of quarters. So far, maybe it's complacency. I don't want to, say that the people buying stocks are wrong at this point, because, stocks were down 20%. You usually buy stocks when they're down 20%. You're going to do great. So, all of these things are happening into the backside of that V reversal. So it kind of messes with your head a little bit, that these stats. But I would say there is some complacency. If there is complacency, it is that I was figuring nobody should care about this quarter. Yeah. And then the way they end up being right, this V reversal, if this ends up being correct and we keep going up back to all-time highs, it's basically that all of this behavior out of companies and consumers, it doesn't have the backside. We don't get the negative ramifications of it, because the news cycle just basically changes before it has a chance to happen.
Yeah, I think a lot of companies are also going to have a bit of a mulligan for Q2 until we have a bit more clarity on some of these bilateral trade deals and some data coming out about the UK deal. We'll hit that in a second here. But, Guy and I did a podcast with John Butters, and we hosted it for them, but it's their podcast. It's the FactSet Insight podcast. It was a Q1 2025 S&P 500 mid-season earnings update. We did that the other day, hit a bunch of this data here with John. So go to the FactSet feed, FactSet Insight, to kind of get that podcast that we just did, and you can kind of rate, review it, subscribe, you know the deal, share it with your friends so people can find it. But a great conversation that we had with John Butters. Let's pull up some of this data that's hitting right now, a framework for a deal with the UK lowering trade barriers. I'm just reading this offline right now really quickly because it's just hitting the tape. They're talking about bringing down barriers and expand market access for American imports. The agreement includes fast-tracking American goods through UK customs, reducing barriers on agriculture, chemical, energy, and industrial exports. The pact is seen as a potential blueprint for future agreements with other economies. Listen, I just want to be really clear here. We have a trade surplus with the UK. This is not something that's going to be a framework for the other top 10 trading partners because we have a big deficit with them. And that's really what they're most focused on. So again, this is something that I'd be surprised by the end of the day. I know we rallied off that. If Amanda wants to kind of look at the intraday chart of the S&P 500, but it's not something that I would suspect should hold too much.
And Dan, you also have to factor in the scar tissue from Brexit. Right over there. So this is the last thing the UK needs to throw on top of Brexit. So
yeah, well, you also have a PM that is wildly unpopular, and so you run the risk, depending upon how easy these trade barriers are brought down, whether their farmers are pissed off, whether some of their men, there's a whole host of things that, again, this is a framework. I don't think there's going to be any signed deals, and I'm not trying to poo-poo it. I mean, listen, for all intents and purposes, most Americans feel that we should have a more level playing field with a lot of our trade partners. But this is also stuff that our manufacturers have done over the last 50 years. They've shipped out a lot of this manufacturing to cheaper places, which has reduced jobs here in our manufacturing. But we have no indication that a lot of Americans, especially with 4.2% unemployment, want to do those jobs. And it's also going to take years before those jobs are going to be available to a lot of U.S. workers. So a lot of this stuff is like, it didn't need to be this way as far as the volatility in the markets and also the uncertainty as it relates to the economy. You could say that's an opinion, but I think that's a bipartisan sort of view about a lot of this stuff. All right, let's go to some headlines that we had. You talked about the Google thing yesterday. Maybe Amanda can show this. The stock gapped up, better than expected results. This comes a quarter after they had worse than expected results. It gave it all back, filled in the gap. Then you had the headline yesterday. This was Apple, Eddie Q, senior executive, testifying at their antitrust case. This is for Google. And some of the commentary, how they said they might be looking to diversify away from search deal that Apple gets $20 billion a year from for Google for exclusive search on Safari on iOS devices. They were talking about moving away from that over towards some AI search capabilities. They mentioned Anthropic. They mentioned Perplexity. The stock was down 8% yesterday. It's bouncing a little bit today. There's some analysts that are defending it, but this is not a meaningful bounce, in my opinion. This is one where it's going to continue to play out. Apple traded lower off of this too. I think it's a no-win for both Apple and Google until they have some clarity about DOJ and FTC action. By the way, Apple is actually in the sights of regulators too, and they have been for years. So this is one where two of the Mag 7 stocks, they basically are in the penalty box a little bit until we get more clarity on the regulatory. CC, what do you think?
Well, can I ask you a question?
Sure.
So when I think of Google and Apple in this space, you and I you're using Perplexity. I use ChatGPT. I don't know what the market penetration of those new.
ChatGPT is very high, by the way.
Do you know what it is?
Yeah, it's. I think they've reached like 300 million monthly active users. I mean, it's big. Perplexity and Claude from Anthropic, they are literally nowhere as far as market share right now. But the behavior is something that's building. And the more that OpenAI, like gains traction, it actually means that other user interfaces have the ability to gain some of that share eventually. Right now, on the Wall Street people and Silicon Valley people and a lot of tech people in general, they're using these things. A lot of students are using, ChatGPT for a lot of the work that they're doing. It will reach mass adoption at some point, and there'll be plenty of room. There's not going to be like winner take all sort of situation. But the big key here for me is the browser wars. And we've been having this for 20 some years or so. It started with obviously going back further to Microsoft, because Internet Explorer browser, that was the reason that they got the sights of, in the sights of regulators going back 25 years or something like that. If Google is meant to one of the remedies is to spin out Chrome, then all of a sudden you lose people who have been using Chrome for the most part, in my opinion, if you have less connectivity to doing Google searches, because that's why they're doing it. If OpenAI, and they will roll out a browser, and so will Perplexity, if you're using those browsers, you're going to be using their search functionality, much less for Google. Does that make some sense to you?
Yeah, and that was basically my question. Is I was curious as to the average person, the normie that isn't like, using this stuff for work or anything yet, and they're simply, how like our parents used to search on Google where they'd ask the whole question, right?
Yeah.
And then, our generation kind of knew which words to use, which keywords would trigger the right results and everything. It's when you Google, like, you're getting Gemini. How many people are seeing Gemini right now because of their old habits, right?
Yeah. Well,
And
part
so
of that, though, is there's a big problem with that. One of the
Yeah.
reasons why Google search is kind of seeing some of the first declines in a very long time, and that's what Eddie Q from Apple was saying yesterday when he was under oath, speaking about this antitrust trial, is that they're looking for other ways to diversify away from Google. They're worried about Google. They didn't even mention Gemini as potential partner on their iPhones. And that is really one of the reasons why the stock got hit so hard. Apple sold off also because Google pays them $20 billion.
Yeah.
Apple had a quarter of their revenue was services last year, $100 billion, and 20% of that was the payment that comes from Google. So it's a problem for Apple too. It's not as big of a problem for Apple as it is potentially for Google. And there's no clarity on this sort of stuff either. So again, I just think this is something that's going to play out. There's no good results, in my opinion, for Google, because they have done a really bad job getting away from the 10 blue links. They're doing those overlays that look like, the answers that you'll get on Perplexity or GPT. But I think a lot of consumers used to like the simple, results that they used to get are getting really confused about what's on the search page.
Yeah, and
Google.
The bottom line is they know, even if they nailed Gemini and they nailed the integration and it's slowly replaced their search, like they're clearly trying to do, it's a crowded space. They're no longer a monopoly, right?
Yeah, no doubt. All right, last thing here before we get out of here, I just want to hit the headline on the chip stocks last evening, and I think it hit right before the close. And this is something that got a lot of tech stocks moving. But first, the chip stocks, the stocks closed up more than 1%. And so, the Biden administration put something in place late last year. It was called the AI diffusion rule. So obviously, we had a bunch of export bans on our best technology. Obviously, that hit Nvidia worse than many of the other chip stocks. They own the high-end GPU space, which is really what powers a lot of this generative AI development. These chips go into the servers that go into the data centers that train the models that are going to have all the inference. And so when you look at Nvidia, it's really been, if you want to kind of like zoom back in here, it had at one point a 35% decline from those recent all-time highs. And so the AI diffusion rule means away from just the bans on exports to China, we were putting these tiers in place for some of our biggest trading partners, which are also our allies, where Nvidia had restrictions on selling to them because they're worried about basically a black market for high-end GPUs from Nvidia getting back to China. This is a national security issue. Make no mistake about it, right? We do not want our best technology going to the hands of China, which is going to find their way into their defense and intelligence apparatus. That's why those restrictions were put in place. So yesterday, the Trump administration said they're going to possibly rescind the AI diffusion rule. So Nvidia rallied. Amanda had the chart up for a second here. It's finding its way to its 200-day moving average. It is interesting today that as of like 30 minutes ago, Nvidia was down on the day. Okay, so I think a lot of folks are basically saying that maybe this is not going to be as good as they expected yesterday. So again, that's really important to track, because if you rescind that, you lose some teeth to the threats that you have with these trade, tariffs as it relates to China. And so I just think that, because of the sloppiness of the rollout of these tariffs, going after our allies first, not focusing on China, and then you start pulling back, TikTok bans and, AI diffusion bans and that sort of thing, you just undermine your positioning from a negotiating standpoint with China.
Yeah, and there's national security. There's a bunch of stories into this one in particular. But to your point, with all of these headlines, backing off, what is the intention here? Is the intention to make trade more fair, or is the intention, to basically win and not get the jobs back to build over here? It's very confusing. And what I would say is anytime you have a confusing economy like this that's going through one person or a small group of people, bet on the big cap stocks because they're in the room, right? They've got the lobbyists.
So we have a really smart team here. Obviously, you got to see how smart CC is right here. Obviously, you all know, man, she is doing fine right now. She's doing well, actually, and she's wicked smart. Even Bill is funny and smart. We got Timmy. We got an amazing team. But Jacob is literally my dark horse right here as it comes to markets. He started out in this business really in sports, which has been fun. He's been with us for maybe almost 4 years now, but he just put through a tweet into our chat, and it's a tweet from a guy named Walter Bloomberg. Maybe he'll pull it up right here. Trump, this is quoting him, better go out and buy stocks now. And Jacob's, his little, I don't mean to kind of get all up in your grill here, but his comment is, that's the top. So I love that. Maybe it is, maybe it's not. I don't know. Maybe Trump is a great stock trader. I remember seeing a news story from 1987, how he said that he sold all of his stocks right before the market crashed. So maybe he is a great stock trader, and maybe you should take his advice. But again, we don't have advice on this site. So there it is right there.
Well, the last time he did this was right before, like, he pumped his own stock and then he pumped the market the morning of the reprieve, the 90-day reprieve. So the market is reacting to this as if we're going to get a big announcement soon.
All right. Well, there you go. All right, people, we appreciate you being here. I appreciate CC stepping in for Guy Adami. Guy will be back next week, and we're going to go through it all again, man. The market call, we're going to be breaking down the trade stuff. And hey, listen, I've been trying to take a silver lining about some of this stuff. I mean, the S&P is down only 3% of the year. It's up 1.5% right now. I mean, maybe we're going to blow through that 200-day moving average. Maybe we're moving back to 6,000. Maybe the trade war is not going to be protracted like we had the first time around. So again, we can all be optimistic about this. There's no reason to kind of root for it one way or another, no matter what your view is on the markets or what your view is on the administration. I mean, maybe it's all playing out the way that it should be. All right. Thanks, everyone. We appreciate you being here. We won't see you tomorrow. We have a great podcast dropping tomorrow in the podcast store. So check that out. It's going to be with Dan Benton. Dan Benton is an old friend of mine. He's a legendary tech investor. We're going to go through a lot of his rules. He's got 20 rules going back 35 years for tech investing. So stick around for that. Drops in the podcast store tomorrow morning. Thanks.